we put out a maiden reserve of 18.9 million tonnes at 1.24% lithium oxide. Now the project itself generates some huge numbers in terms of economics. So we've got an NPV8 of in excess of 1.3 billion, internal rate of returns at 224%.
Hello, welcome to Assay TV. Today, I'm delighted to be joined by Kolff, who is the interim CEO of Atlantic Lithium. Atlantic Lithium are developing Ghana's first lithium mine. Len, great to see you here today. If we could start things off, let's talk about your Ewoyaa project there in Ghana. As I mentioned, you're planning this to be Ghana's first lithium mine. Tell us a little bit about the resource you've delineated there.
Sure, great to be here. Thanks, Leo. And so we've made Ghana's first hard rock spodumene pegmatite discovery right on the Atlantic seaboard, and right next door to the N1 highway that takes us to the operating deep sea port of Takoradi. So since we commenced drilling back in 2018, we've drilled in excess of 90,000 meters to define the current resource that we used for the PFS, and we're in the final phases of completing a 37,000 meter program, which will lead to a resource upgrade hopefully at the end of this year. But so the drilling that we've done for the current resource sits at 30.1 million tons at 1.26% lithium oxide. So it's a significant hard rock spodumene pegmatite discovery.
Excellent. And as you mentioned there, you're doing some more exploration, so you're hoping for a resource upgrade later in the year. But you've recently put out a PFS. Some of the highlight economic numbers from that, if you could share those with us.
Sure. Yeah. So we put out PFS last week, and it's been a very busy year delivering that PFS to market. It's delivered some exceptional economics and really demonstrates the robust nature of this project, notwithstanding when you look at our resource to reserve conversion. So we put out a maiden reserve of 18.9 million tons at 1.24% lithium oxide. Now the project itself generates some huge numbers in terms of economics. So we've got an NPV8 of in excess of 1.3 billion, internal rate of returns at 224%, and life of mine EBITDAs in excess of 240 million per annum. And all of that leads to a fantastic payback within 5 months on capital of the processing plant. So a really robust, solid project.
Absolutely. I mean, that 5-month payback period sort of really does leap out of the numbers there. Tell us a little bit in terms of the cost, the initial startup capital costs. How's that looking?
Yeah, so look, our capex costs are sitting now at 125 million US, and that's a bit of a change from when we put out our updated scoping study in December. However, the design philosophy has changed significantly from that scoping study to where we are now with our PFS, notwithstanding the resource grew by in excess of 40% from that scoping study to now our PFS sitting at 30.1 million tons. But so $125 million capex, we bought in all of the primary crushing operations in-house, as opposed to contracting that as part of the scoping study design. And that's quite important. The real sensitivity in a DMS only process flow sheet, which is what this project's contemplating. We don't need to go to flotation. It's all about physical separation through density contrast. So low capex, low opex. But the most sensitive part in that processing flow sheet is your primary crushing and trying to minimize lithium losses through fines generation, as well as trying to maintain your particle size as coarse as possible through that DMS flow sheet because it enhances or maximizes your recovery. It also gives us some improved operating costs through that process flow sheet and just keeps it simpler overall.
And you think that keeping it in-house is a better way for you to manage your costs going forward, yeah?
Yeah, look, the biggest challenge with subcontracting out is A, having contractors there with the right equipment first and foremost, but B, those contracts are often targeted around or structured around productivity, and that's the driving force from a contractor to push productivity through that crushing plant. And that's what generates increases in fines when you're trying to push that crushing plant to the maximum. And hence you see lithium losses through fines generation as opposed to securing those in your spodumene concentrate product at the end of the processing flow sheet.
So how are the figures looking in terms of your OPEX?
Yeah, so look, our OPEX has given us some very good numbers. I just need to remind myself of those looking through our release here now. So C1 cash operating costs of $278 per ton, SC6 free on board. So that's really demonstrates the robust nature of the project. So it's a simple mineralogy through a DMS only process flow sheet. So it's very low in terms of consumables. You're not using any chemicals in that process flow sheet, which you would otherwise have to if you're going down flotation. Power consumption is very low. Water consumption is very low. And then we're only 800 meters from the national highway, which is then 110 kilometers to an operating deep sea port at Takoradi. So that all equates to low operating costs per ton of SC6 produced.
Absolutely, and that local infrastructure is important, isn't it? I mean, Ghana, obviously a well-established mining jurisdiction, albeit mainly focused on gold, but the infrastructure is there, yeah.
Correct. Yeah. Look, I mean, Ghana's a fantastic jurisdiction, pro-mining jurisdiction. It's been on the map for a very long time as a gold destination. And accordingly, there's a lot of skilled labor in country from right across the value chain in the mining sector. Whether you're talking geologists, environmental scientists, mining engineers, process engineers, and all the support that goes around that. So we're very lucky to be where we are. There's a ready and available skilled workforce where we are. And given where this project's located, it attracts a lot of interest from prospective employees who, see they can go and work somewhere where they're much closer to home, being only 100 kilometers to Accra, and around some, very vibrant communities, Cape Coast, Salt Pond, Mankasim, with good schools. So, that really will attract some of the skilled labor workforce that is currently working in much more remote areas around Ghana or indeed within West Africa. So, that certainly helps us in that regard.
Absolutely, and it must be helpful as well that it's a fairly conventional project as well, open pit and a very sort of conventional, straightforward flow sheet. Yeah. Yeah,
correct. Look, I mean, hard rock pegmatite projects, they're essentially almost like a quarrying operation. It comes to surface, the pegmatites. We've got life of mine strip ratios of 8:1. Our host rock is all a schist and or granite that's inert. We don't have any associated sulfides, which you often see with gold operations, and accordingly, you don't have any of those acid rock drainage issues, and all of the engineering design that needs to be put in place to manage that. So that certainly helps simplify the project, and also in terms of the actual spodumene concentrate that you produce, it's chemically inert. We produce a sand byproduct in addition to feldspar and DSO fines. Feldspar actually goes into ceramics industry. There is currently a ceramics industry locally in Ghana within the area where the project is. So there's a real opportunity there to value add in country in that regard. The DSO finds currently there's a market for that, given the huge supply demand issues that we're seeing in the lithium space currently. The sand material, can go into local industry in terms of building supplies. So it's a very clean, simple, small footprint project, which goes a long way in terms of helping to permit this when you compare it to a large throughput gold operation where they're grinding everything right down to microns to liberate the gold.
Absolutely. I mean, that was going to lead into my next question. So that sort of situation around the project and the simplicity of it does that help you with your mining lease application that's coming up and your sort of environmental and social impact assessments? Yeah,
look, I believe it will. But, it's the first lithium pegmatite that's been discovered in Ghana, and it's going to be one of the first operating lithium mines within the region. And accordingly, there's a bit of a learning process to go with that. So, we're starting that process now. And that's an important step to show those differences between what the country's used to in terms of gold operations versus the simplicity of a DMS hard rock pegmatite operation. But we've got the full support of the government and the full support of our communities to push this through that permitting. So we're hopeful it's going to be a very quick process.
What are the sort of timelines you're expecting, and then timelines towards sort of first production?
Well, so for us, our key milestone is submission of our actual mining license application. And now that we've finished our feasibility study, we're able to submit that. It's then we're looking at in the order of a 12-month timeline for mining license and EPA approval, which is then ratified by government to then allow us to break ground on the project.
Excellent. Can you tell us a little bit, though, about your sort of funding of the project and your relationship with Piedmont Lithium? I understand you've got an agreement with them for funding and also for offtake.
Correct, yeah. So Piedmont is a joint venture partner. They're currently funding us through studies. They also hold just under 10% at Topco. And basically through the agreement that was ratified between us approximately 1.5 to 2 years ago, Piedmont are funding us through all those studies to earn into the asset level, 22.5%. And once they've funded us through to DFS, they've then got the option to fund up to $70 million towards CapEx. Once that $70 million has been spent on the project, they then earn 50% at the asset level, and they'll have rights to 50% of the offtake from the operating mine at market rates. Now, Atlantic maintains control of the project through studies and mining, and Piedmont retain 50% of the offtake at those market rates I mentioned earlier.
Absolutely, and I guess there's no shortage of demand for the other 50%.
Yeah, we've been inundated with groups for our remaining 50% offtake, which currently is uncommitted. So it's extremely strategic, the value of that offtake, especially now you're seeing these growing supply and demand issues around spodumene concentrate in particular. So we've been very much focused on delivering the PFS and our dual listing on the ASX, which we've now done as well. And we've finally got some breathing space to decide strategically on the next steps around our 50% offtake. But it's not a time to rush into these things, and we really need to structure some kind of deal that will add value to our shareholders, given that a large chunk of our capital has been funded through our Piedmont agreement.
Absolutely. As you just touched on there, it's been a very busy time for the company because you've, as well as doing the PFS, you've also just listed on the ASX. What was the sort of rationale behind that?
Look, the company is domiciled in Australia already. So I'm Brisbane based, and the corporate head office is in Sydney. Our study team is in Perth. And over a third of our existing shareholders are domiciled here in Australia since the company IPO'd back in 2014. At that time, the company was called Iron Ridge Resources. It had a grassroots iron ore project in Gabon and West Africa. And that kind of story was a lot more favorable to the AIM and London space as opposed to here on the ASX, and hence why the company listed on AIM. But now, given the fact we're domiciled here, a large portion of our shareholders are Australian. It kind of made sense to get that secondary listing here on the ASX, notwithstanding some of the valuations we're seeing amongst our peers here on the ASX. So Australia likes the lithium space, and it made sense to list the company, to have that dual listing on the ASX.
And how did that go, the launch on the ASX?
Yeah, look, it was a tough week to list on the ASX, but we held our ground, and we closed on par with opening price, and we've subsequently lifted, raised in terms of our share price to what we listed on. So performance has been good in the current macro market economics. So yeah, we're pleased with that, and now we've got the foundation to really start to promote and show this story within the Australian investment sector, and continue to do that with our very strong and loyal UK retail and investment sector.
Excellent. So going forward for the rest of the year, what are the sort of key milestones that people should be looking out for? Well,
we're in the final stages of completing the 37,000 meter drilling program that I mentioned earlier. Now 2/3 of that meterage was designed for infill, so to increase confidence, to convert our remaining inferred to indicated, as well as converting our first 1.5 to 2 years of indicated to measured. So that will all lead through to a resource upgrade at the end of this year. And in addition to those 2/3 of the meters are assigned to increasing confidence in resource, 1/3 of that meterage was assigned to resource growth outside of the current resource footprint. So that's trying to add more tons to current resource of 30.1 million tons. And we have announced some pretty exciting results outside of the current resource footprint, including highs of 69 meters at 1.34%. So we're expecting to see a resource upgrade, and all of that drilling will see continuous news flow between now and the end of the year, and hopefully a resource upgrade at the end of this year, which will feed into the next round of studies.
Excellent. Well, we look forward to seeing that, and hopefully you can come back and tell us all about it when you've got the resource upgrade coming out. But thank you very much, Len, for joining us today and telling us all about Atlantic Lithium.
No, great to be here, and thanks for the time. Thank you, Leo.
Thank you very much.